everyone. My name is Amrita, and it's my immense pleasure to welcome you all to the Venture Intelligence PVC Conclave 2025. This flagship event brings together over 20 distinguished voices from across the private equity and venture capital ecosystem to share insights, emerging trends, and forward-looking perspectives shaping the industry today. We've designed the agenda today to be interactive, so do take the opportunity to connect, more importantly, ask questions, and exchange ideas during the panel, and of course, during the networking breaks. But before we begin, I'd like to take a moment to thank our partners and sponsors whose support has made this event possible today. Our sincere gratitude to our sponsors, Brand Capital, Gaja Capital, Stakeboat Capital, TVS Capital, and CIGAER. A big thank you as well to our knowledge partners, Chandyok and Mahajan, Resurgent India, and Saraf and Partners. And of course, thanks to our banking partner, DBS, and our HR partner, Zenith HR, for their continued support. We truly appreciate your partnership in bringing together this platform for meaningful conversations and collaborations within the PEVC community. On that note, let's get started. So if any of you are still bringing in your coffees, please do that, because we're going to have a very exciting panel to begin the proceedings today. This is our inaugural panel, Exploring the Macro View. We welcome on stage our speakers on the inaugural panel. Please join me in welcoming Mr. Craig Gifford, Head of Private Equity Funds and Co-Investment, British and International Investment. Can you please come on stage, please? Ms. Sushma Kaushik, Head L&T Innovation Fund. Big round of applause, please, for all of our panelists. Mr. Srini Vudayagiri, President and Head Brand Capital. Mr. Mukesh Bajaj, Founder, CIGAER. Mr. Santanu, Mitra, MD and Country Head, Corporate Banking, Large and Midcap, DBS Bank, India. And finally, our panel will be moderated by Mr. Arun Natarajan, Founder, Venture Intelligence. Please have a seat. A big round of applause for our panelists, please. Thank you. But to set the context for our inaugural panel, we begin with a quick look at some of the high-level PEVC investment and exit data updated for the first 9 months of 2025. For that, I invite Mr. Hari Krishnan, Advisor, Venture Intelligence, to share the presentation and key insights with us. Thank you.
A pleasant morning, all of you. Without much ado, I'll straight jump into what the data says for the first 9 months of this year. A quick brief on Venture Intelligence. So as you may know, Venture Intelligence has various database products, newsletters, events, etc. Some of the products are the deal database, which covers the transactions, PE transactions, which include VC, with a rich data on valuation multiples, EBITDA multiples, so on. A company financials database, which covers about 60,000 companies and another 100 companies per day getting added. M&A deal database, real estate deal database, directory of investors and service providers, conclaves and events. We also have non-paid for free products, such as weekly newsletters, directory of early stage investors, and blog posts. You can follow us on Vudayagiri, LinkedIn, and check out our website. Events also do, they're a part of our offering. We do usually 2 events in a year. Apex event is the biggest, that comes early part of every year, usually Feb, March. So coming to the first 9 months, you'd see year till date, we have touched about $21 billion. And this is across 837 deals. Projecting for the end of the year, we would be doing about 1,100, and this would more or less likely be at par with 2024, 2023 periods, right? Not a breakout here, but sort of consistent with the recent previous years. And if you look at the quarterly data, that's a lot more encouraging. And while there was a little bit of a dip in the initial part of the quarter, the previous quarter, the current quarter and already October as well are seeing a good swing in overall number of investments. The quarter 3 already crossed $5 billion, and in quarter 4, in October, just the starting of quarter 4, we've already seen 9 investments with $100 billion plus ticket size, $100 million plus ticket size each already. So that augurs well for how the year is going to end. And so we are looking at the $100 million above check sizes, the larger ticket sizes deals. There are about 48 year till date, and the average is about $25 million. And this is only year till date. If you look at the top deals of the year, so you have 2 major sectors here. BFSI, significant number of deals in the top 5-6 deals are BFSI deals. And you also have a couple of FMCG deals, Haldiram being the largest. And you have Saman Capital, IDFC, Federal, and a bunch of other banks and NBFCs amongst the large deals. If you look at the split by industry, the largest sector is continuing to be IT, ITS. No surprise, it's been consistent over the last previous years. So out of the $21 billion, more than 1/3, $8.3 billion is IT, ITS, followed by BFSI that we just saw among the top deals, $3 billion, and then followed by manufacturing, FMCG, energy at $2 billion each. And by stage, growth, late stage, and buyout, these are the 3 stages that continue to have larger investments. Of course, buyout has been a little bit lower than previous year, but that's looking good in the current quarter as well. Let's look at the exits quickly. So this year has been reasonably good. It's about $16 billion in exit, and there are a couple of larger exits that are already in the making in form of IPO as we see. Grow IPOs upcoming, Visho is about to come, and a bunch of others are lined up as well for the rest of the year on the tech IPOs. While tech IPOs sort of get our mind share, there are also a lot of P-backed IPOs that have come, which we will just quickly see. So this is a quarterly trend. As we are speaking, the quarterly exits are on the race. 43 deals, 57 and 64. And the first month of this quarter is already looking up as well. By deal type, as we said, public market IPOs and strategic sale. So they form the significant part of the exits. These are some of the top private equity exits. Many, as you see here, are strategic M&As, INR and JB, and you also have some IPOs here. The largest IPOs, Hexaware, Lenskart, NSDL, JSW, and Anthem. And while you again see a lot of tech IPOs, but as you see, the top 5 has 4 on 5 are non-tech companies in that sense. Thank you all. Have a pleasant day. Look forward to an interacting event day today. Thank you.
Thank you, Hari. Yeah. Just check on the audio, please. Am I audible? Yeah. Okay. Very, very interesting in terms of data. And in fact, what an interesting year 2025 is turning out to be. So much so that I actually put it into Google, as to why this phrase, may you live in interesting times, is kind of considered more of a curse than a blessing that it sounds like, right? So, in fact, Google, and which is now predominantly Gemini, pops up and says that an interesting time is one that is described as with a lot of conflict, a lot of turmoil, and difficulty, So definitely sounds very gloomy. So if you look at what's been happening in the macro landscape, country, internationally, we started off, let's say May 2025, after a significant uneasy peace with our good neighbor Pakistan. We kind of exchanged a few missiles, bunch of drones, and not a so happy scenario at all. And conflict is not just in India and Pakistan. Russia and Ukraine have been at it. I don't know what is the latest on Israel-Gaza. It changes by the day. But, that one conflict is a tick, the way Gemini describes it. Unfortunately, obviously. Then we look at turmoil. In fact, at Gemini, I actually read that word as Trump, so let me just leave it there. Uh, Difficulty, thanks to Mr. Trump's decision on, obviously the tariffs 50% and then visas, there is enough difficulty for corporate India as well as families who have, friends and family out in the US, difficulty, another checkbox, right? So Gemini seems to be getting it right. But is it all doom and gloom? Not at all, right? So just in this week, like Hari mentioned, we've had 2 unicorns completing their IPOs. Lenskart is finished, Grow is on, and more lined up. As we saw, there is going to be Misho, there is going to be Pine Labs, and by the end of the financial year, I expect most of these, ones that are lined up apparently are going to go through. And just yesterday, we had homegrown private equity pioneer, Chris Capital, announce its largest ever Fund 10 at $2.2 billion, right? So something is going right, especially for a dead economy. We seem to be doing quite well, right? So, as Hari presented, we were actually scrambling to update the data of the 9-month with just the October data, right? So October, like he mentioned, had 10 100 million plus transactions, including $1 billion, right? So, and this is something that's changed in the air. In the first 9 months, we were kind of averaging a $2 billion a month kind of figure. It's popped to $5.5 billion in October. So something seems to be changing for the better as we get towards the end of the year in just investing as well. So there is clearly a lot of optimism as well, and far from doom and gloom. This, and especially Chris's announcement yesterday, is going to be followed. During the day today, we are going to deep dive into venture immediately after this panel, and post lunch we are going to get into growth capital or mid market, and then last but not the least, private equity. So we're going to have very different flavors as we go through the day today. Venture, obviously, we have some of the best homegrown as well as international funds who are going to be speaking on the next panel. And there is enough excitement about AI and so many other things. In fact, we're going to ask them, is it only AI? Are we going to get a little different flavor as well? Because in the US, as we all know, it's AI and everything else, and that everything else is really down. In India, I'm sure there's a different picture, but we'll hear from the fund managers in that segment. Post lunch, as I said, growth capital, another pioneer in private equity in India. They've just received their SEBI okay to go in for an IPO, right? So we're going to hear from them as well. And last but not the least, like I said, the private equity panel, we're going to have 2 of the largest homegrown private equity firms talk about why they are doing pretty much only tech these days. And we're going to have one international US headquartered private equity firm, which is doing only non-tech in India. So who's getting it right? We're going to hear from those guys, in the at 4:30. So bottom line, we're going to have a very, very interesting day. And make sure that you don't go anywhere until 6 p.m. today. This is going to be riveting stuff. As far as this panel is concerned, we're going to try and keep things a bit macro. And that means Mr. Trump, right? So AI maybe. But, the idea is to learn from these folks who represent a spectrum, starting with, strategic investors who are homegrown, one of the earliest of them, and we have one more, which is, very recent in terms of their announcing, and they're keeping a lot of things secret, let's say here, which is not a great news for us. So we're going to help her get, opened up in terms of what L&T Innovation Fund is all about. So then we have a representation from one of the largest LPs who is international but in the Indian market, and he's going to give us a perspective which is going to be obviously very, very interesting for the GPs in the room, as well as direct investing that, they as well, they know India far better. And also always, when you look at India from outside, you get a very different perspective, unlike folks like us who are looking at, every day, right? So fabulous to have Craig over here as well. And we have one of the leading banks in the region, in the form of DBS, who's going to give their perspective of working with this ecosystem and how they are getting involved. Again, it's going to be very interesting to get that perspective. And of course, from the kind of risk that we are all dealing with today, who better than somebody who knows the risk from a day-to-day perspective at CIGAER. We're going to have his perspective as well. So it's going to be very interesting in an hour and a half, and we love to, like we was announced, that keep it very interactive, and we'll have enough time for Q&A towards the end. So with that, let me just go around the panel to get a feel for one, to talk about themselves, personally, as well as their organizations, and kind of start by saying whether they found 2025 to be as interesting as I found it to be. Craig, we'll probably start with you.
Hello. Yep. Hi. I'm Craig Gifford. I'm a director on the private equity funds and co-investments team. I've now been with BII for about 20 years and focused on sort of private equity funds in India since about 2007. BII, as you're probably all aware, we're an impact-focused investment firm owned by the UK government. We sort of have three areas that we want to have an impact on: productivity, sustainability, and inclusion. We focus on Asia and Africa. We have sort of a $10 billion balance sheet, and about a quarter of our capital is focused towards India, and we invest across sort of three products. So private equity funds, direct equity, and debt. And that's everything from VC up to infrastructure there. And so, look, I think this year has been interesting, as you said. We've had to be, I guess, watching what sort of Trump says and what happens around that. And you got to be cautious this time. It creates the uncertainty. But then, and India, I think, in a way, has been sort of countering that quite well domestically. And before I dive deep into there, like our other markets, and most of our capital is invested into Africa. And so from a relative basis, India is actually more stable and more secure than some of the macro challenges we've been facing in Africa, where you've had currencies depreciating 10, 12% per annum, big challenges there. And so on one side, it makes it more stable from that side there. It does mean that, at a portfolio monitoring perspective, we are constantly waking up and sort of seeing, do we need to sort of assess what the risk is in our current portfolio and our pipeline? It does mean longer gestation periods for transactions as well. And so it's just trying to understand, what does this all actually mean at the end of the day? And I think because of our focus on India with an impact focus, we are trying to sort of see, particularly on sort of the sustainability and the inclusion side, that's very domestic focused. And so when we look at our portfolio, we have quite a very small direct, or actually mostly indirect, exposure to sort of the global markets and the slowdown there. And so we've actually been quite immune from that. And lots of the areas we want our capital to go to are actually in line with what the Indian government wants to develop around sort of the climate areas, around sort of job creation, making India. And so we've actually seen it to be quite aligned, and that's actually been quite beneficial to us. So we've seen it quite an interesting, a positive time. There has, look at the stats there, that there has been sort of a slowdown in sort of deployment, but at the same time, that's a positive. I think people are being more cautious, making sure they enter at the right valuations. We're still seeing the exits come through as well. So look, we've got to be cautious. You've got to sort of recognise that there are things that are going to come up that we're not aware of today. But we are still deploying, and it's probably a good time to be investing into India, is our view. And some of the spaces we're trying to invest into, I think longer term will be quite, will deliver good returns. But they are, by nature, our strategy is willing to take on more risk. But I think that longer term, some of these bets will actually pay off there. So at the macro, we're comfortable moving forward, but at the same time, we're sort of doing it fairly cautiously.
Thank you so much. Sushma?
Yeah. Hello, everyone. I'm Sushma Kaushik. I head the L&T Innovation Fund, which is a newly formed corporate venture arm of L&T Group. L&T Group, of course, spans multiple businesses, all the way from construction, engineering, heavy engineering, renewables, data centers, recently semiconductors, We have our group companies in engineering design, in IT services, and finance as well. So the mandate for the corporate VC arm is to find startups more deeply entrenched in the Indian startup ecosystem, something that the group had not really paid attention to, and now they are sitting up and understanding that there's a lot happening in this ecosystem and that they cannot be left out of it. So they want to engage more deeply in the startup ecosystem in areas that are allied to the L&T businesses, to see how we can grow certain areas. Specifically, we have a very big presence in what we call the precision engineering, which is focused on both defense and non-defense electronic components as well. We understand there are supply chain challenges that we are facing as a country, and so what can we do to develop our expertise indigenously as well. Also, when it comes to sustainability, L&T is a thought leader when it comes to sustainability. We have also just recently procured close to $700 million of sustainability-linked trade facility, which is first of its kind, and it is all linked to the net zero targets that we have as a group. So there are a lot of both engineering as well as process innovation that we do within the group, and we want to extend it to the startup ecosystem to see whether we can collaborate and grow together stronger. So that's about us.
Thank you. Srini, as one of the most experienced strategic investors in the country, please tell us how Brand Capital is viewing things.
Yeah, thank you very much. Thanks, first of all, for inviting me to join this interesting session. Arun, first, as I was mentioning before, kudos to you in terms of doing this over the last 2+ decades. One of the earliest movers in terms of bringing together the fraternity and ecosystem together with various things. Really appreciate the efforts in terms of keeping at it very consistently. Thank you very much for doing that. As Arun said, my name is Srini. I represent Brand Capital here. For the people who are not aware of Brand Capital, we are the strategic investment arm of Bennett Coleman, BCCL, which is more known by his brands, Times of India, which is the largest circulated English daily in the world, and Economic Times, which is the second largest circulated financial daily in the world. As Arun said, we've been doing this as a strategic investment program for Times of India for the last 20 years. This is 20 years in the running. That does make us one of the very, very early stage investors in the startup ecosystem. And we're fortunate in terms of seeing many of these cycles, ups and downs, resetting in the market, whether it's a GST reset, what happened, the COVID, or many Trumps who have come and gone. And we've been part of that journey. And this journey over the last 20 years enabled us in terms of participating with close to 1,200 entrepreneurs. Cumulatively, we committed about $4 billion in these 1,200 investments. So it's a program which continues to be very steady. It's a stage and sector agnostic and a size agnostic program. We work with multiple sectors, and we take pride in terms of actually inviting and discovering some of these sectors ahead of the curve. And during the course of this, if the time permits, I will be more than happy to share some of those journeys and how we have been playing our role in terms of getting these to market. In these 20 years of our journey, it's also that good to mention and share that we had our share in terms of getting 15 unicorns out of around 120 unicorns in India. We are part of 15 unicorns, some of them which have become public, some of them which are going through the public right now, one of them very soon, which has received the SEBI approval. It's in the process of getting to the markets in this year. Specifically, my 2 cents in terms of what's happening right now, from our vantage perspective from investments for this year, which was the other part of question what you asked, Arun, is I look at from ourselves, where are we today? Based on the first 9 months of our experience, we do see that we'll be somewhere between 20 to 25% ahead of last year in terms of our committing capital this year. So we're clearly seeing a robust operations and opportunities, maybe because we're just not looking at only AI and not really getting troubled by Trump that much. The fact that we have that long-term view, and maybe also the advantage that it's at the end of the day, it's a balance sheet program. It's a strategic investment arm, so we can be patient through the investment cycles and have that flexibility in terms of tuning our orientation, how we want to look at these investments. Happy for this, and hopefully later in the conversations, more than happy to share more information.
Thank you so much. Shantanu?
Hi, thanks, Arun. For everyone, I am Shantanu Mitra. I head the corporate banking function for DBS Bank in India. Now, a lot of you may or may not be aware of, what's the depth and spread of DBS. So we are the largest bank out of Singapore, largest in Southeast Asia by market cap. But besides that, I mean, we have been present in India from 1994. Today, the total balance sheet that DBS has on India is in the order of about $30 billion. And both onshore, offshore combined, we have 550 branches. Unlike any foreign bank, HSBC, Citibank, etc., we don't operate as a branch of an overseas subsidiary. DBS Bank India Limited is a subsidiary which is incorporated wholly in India, and therefore we are almost comparable when it comes to the regulatory paradigm to a local bank. Now, in terms of, what's the overall take now, when we look into our sort of areas of operation, there are 4 or 5 core markets, 6 markets, which we say, which is Singapore, Hong Kong, China, India, Indonesia, Taiwan. Now, in this, and maybe to an extent Vietnam, and then we have some satellite markets present across Asia as well as Europe, in London and US. But for our core markets, we think that India is the most important market for us from growth perspective. And therefore, as a group, we have a significant appetite. We have gone ahead and acquired this bank called Lakshmi Vilas Bank, which has led to us acquiring this 550 branch network. Then when it comes specifically to the tech ecosystem, it's kind of close to our heart coming from Singapore, because as Ms. Kaushik was mentioning there, that precision engineering, this is where Singapore grew. So we understand that. When it comes to data centers, semiconductor, this was all a core area where Singapore grew over from, let's say, 1990s to the mid-2010. And DBS has a deep expertise. And we see a virtuous cycle like that happening in India now, with both the government's initiatives around PLI schemes and otherwise, as well as the overall sort of enthusiasm around the tech ecosystem, which is migrating a lot from pure software to a lot of hardware, whether it is, investments in electronic manufacturing services, in semiconductor, in data center. And that's where we see a huge opportunity for banks to, partner with the tech ecosystem and grow. So we remain very bullish. And specifically with respect to this segment, we also have, from 2021, we have set up this initiative called, we call it Digital Economy Group, where we partner and bank the startups. And besides banking them from a working capital finance perspective, which is through the bank's balance sheet, we have also set up a fund called Evolution X, which is largely, we are the largest LP. And there we invest in companies as in form of venture debt. And so it's a $500 million fund, of which I think $350 million is already deployed. And the significant majority of deployment has happened in Indian startups. So maybe there are 2 or 3 which are in Singapore and Indonesia, but the remaining 8 or 10 investments are all in India. So that also shows the sort of long-term view and the commitment that the bank has, and the sort of irrespective of Trump. And I would like to reiterate, Srini, that many Trumps come and go. Even Trump does something today, does something tomorrow. So we remain focused on the overall opportunity in the market. Thank you.
Perfect, perfect. Mukesh?
Taking the last statement, one of the Trump's news channel Fox back in 2008 had mentioned about the growth in Indian economy, and it said India grows when the government sleeps. But now imagine if the government is very well active and all, which is the growth engine will continue further. Hi, my name is Mukesh Bajaj. I represent a company called CIGAER. We are into the business of due diligence, background checks, and investigations. We have been in existence now for almost 16 years. 14 of them was basically working as an incognito under the radar firm, working on behalf of a lot of international investors and intelligence and investigation companies all over the world. Personally, I have had about 29 years of experience in this business, having done diligence work when there was no internet, which was a challenge part of it. Transaction diligence is one of the largest part of our business, which basically we are present across the entire spectrum of the investment, right from pre-transaction stage to post-transaction monitoring of the investments to addressing issues at the investee companies, including matters relating to conflict of interest, appointment of CXO positions or independent directors, or looking at other matters that keep coming up by way of a whistleblower or something of that sort. And then including if there is an issue with disputes, there are quite a few cases that come to our table where there's a dispute between the investor and the investee companies where we represent either of them. And post-transaction, when the investor has to go either the IPO route or the other side, we have a robust program for fit and proper checks where we prepare the company for the IPO route or go to application through SEBI. Plus also a lot of best practices we implement at the client company, which basically helps them manage their compliances and prepare the organization for quote-unquote public scrutiny tomorrow. Apart from that, we also work a lot on disputes. We have a large team of people working here in Mumbai, with office in Mumbai, Ludhiana, Hyderabad, Dhaka in Bangladesh, and Colombo. We have a sales office in London and a representative office in New York as well. In a nutshell, we've done almost about 8,000 projects in the last 16 years, and this year has been a fantastic run. Our India initiative was launched in 2023. This year, we have already had registered almost like a 40% growth in the business. Happy to be here, and thank you for making part of the panel.
Yeah, thank you so much. And probably start again with you, Mukesh, on kind of deep dive onto the current scenario. 2025, you said 40% growth, which means risk is good for you. But, a little bit on the macro stuff as well.
See, globally, when investors come to India, I'm going phases-wise, when in the initial years when India was just opening up and people coming in, the risk was quite different. People were not aware of companies in India. The focus was more on information. Focus was more on about genesis of the organization and what they have done and how they have become so big. Fast forward further, the issues relating to governance, issues relating to risk associated with the company became more important. Today, the challenge is quite different. I would say the latest round of entrepreneurs coming in do not actually have any history. They do not have a background. They are youngsters coming up from business schools or from engineering institutes starting up. So getting to the root or getting to the background to understand how their behavior is likely to be shaped up in the future is a big question mark. So the challenges are different. You have to rely on a lot of other small factors or small snippets of information to be able to understand how the entrepreneur is likely to behave if you're going to bring a tsunami of capital into him. Whether he's going to be overwhelmed with him, whether he's going to be spending it on matters which is outside. So what has happened is, while the pre-transaction thing is absolutely essential and it has to be conducted, a lot of firms are now moving into monitoring. We want to monitor how the capital is being deployed. While you have a board seat in place and everything is there, but there's a lot that happens between board meetings. And that's where we actually come in and actually keep a very close, tight eye on that.
Perfect. So we'll go to the investors side now. So Craig, on a, if you can help us, the audience, figure out, because BII is both a direct investor as well as an indirect investor. So how does it work in terms of what BII, a typical BII investment is? Let's take, for example, indirect investment. If you can highlight, so does BII do first-time funds, right? So what is, either it's in the direct side or the indirect side, what is a typical BII investment? What is okay with you and what is, not okay?
Yep, certainly. So I think we look at it, whether it's a direct investment or intermediated investment, we look at it in exactly the same way in the initial thing. The first two criteria that we look at really is what's the potential impact from that company and that investment or that fund manager, and then can we make a commercial return from that? And both of those are equally important. Now, on the impact side, we're looking at sort of how does it fit with our priorities on sort of job creation, on the climate side, on the inclusion side. It doesn't have to hit all three. It doesn't have to hit score 10 out of 10 on that, but at least needs to be high on sort of the sustainability side or the inclusion side. And then another criteria within the impact side is around additionality. Our shareholder wants our money not to crowd out other capital, private capital. It wants our capital to go where capital is not currently going. Or there's less capital, there's higher risk there. And so that pushes us out of a lot of transactions that look commercially attractive, but at the same time, it helps develop up-and-coming sectors, up-and-coming opportunities where other private investors may not yet be comfortable taking on that risk. So that impact criteria is important, and when we're assessing fund managers, it's sort of who can help us get capital to where capital is flowing less. Where can we get sort of co-investment opportunities alongside those managers to help scale up those businesses? And so that's on the impact side. And then we also need to make a return here. So it's not just a case of taking the risk and across the portfolio not making that return. Then we'll take some extra risk, and we're happy to do that. And so it's sort of just really understanding what's the probability of this actually delivering the returns we want, and a lot of time spent around that. So the initial phase is really around that, and we spend a lot of time on that. Things like ESG for us is just a core and a hygiene. We'll dig into that much deeper later, but initially it's more around the red flags, like what is the reputation of the promoter group? What is the reputation risk around their ESG practices? Are they showing signs of being aligned and working with us around these areas? A lot of that will be dug much deeper in the diligence stage, but we sort of need to get sort of a red flags check initially around those things. And if it passes all that, and there is a strong case for us, then we go into the more deeper diligence stage, and look at the impact, environmental, social practices, business integrity, sort of their legal compliance practices. And so it's the impact and the commercial part that we really need to fit, and whether it's a fund or not. And so on the direct side, we're looking at things sort of more the $25 million plus side. Our funds actually play a good feeder into that. Back in 2019, we stopped backing more generalist funds. We decided strategically to sort of focus more on impact-focused funds, be it on the climate and the inclusion side. They're typically doing smaller transactions, but it's actually a good feeder for later on as well. So it actually complements what we are doing there, be it on the VC side or the early growth private equity side.
So first-time funds are okay?
We do first-time funds on that question. So I guess going back historically, we never actually had a mission to do first-time funds. It was just the reality was back in 2005-04, there weren't many fund managers around. We backed the ones who were around at that stage, who many are not around today, but you had to, by definition, back first-time funds. And LPs, even us, we don't need to take that increased risk of backing a first-time fund, except if it's a new segment or a new space that others are not yet investing into. Now, we may take that risk. We'll be looking at sort of really the individuals and their track records, but them coming together, potentially manage a fund for the first time, being a fiduciary of capital for investors, has a first-time element to it. They're probably going into segments or spaces which other investors haven't necessarily, like there's a question mark on the depth of the opportunity there. And And so very selectively, we will back first-time managers, but it's never been a priority for us. And even DFIs, it's risk on risk, but we will do that very selectively.
Thank you. Sushma, so give us a little bit more of a flavor on sector preferences, stage preferences at L&T, and how much, for example, do the business teams get involved in a transaction, and anything else that you would care to share on things like whether you can lead a deal, whether you need other VCs like other strategic investors typically do, board seats. So give us a flavor of what you have.
No, see, the whole corporate VC ecosystem in India is still very, very early, and it's good to see corporates are now taking more active interest in this. And, being in the VC ecosystem, I think having corporates participate is very, very important, especially in certain areas, which are very, very critical to our country as well, right? So in that, with that said, our fund, we invest out of the balance sheet. L&T kind of reported close to 15,000 crore of PAT last year. It's growing at a healthy, all the businesses are growing at a very, very healthy pace. So while there is no fund allocated, things are going to be looked at very strategically of how it aligns to certain businesses. We ourselves have incubated many new businesses that I was talking about, which is the data center, semiconductor, green tech business, which is very big, which is into green hydrogen, ammonia, fuel cells, battery tech, all of those, right? So with those kind of investments, for a corporate, even those are startup investments within the group. And we look at investing in startups in those areas as well. And so while, these are very, very technical subjects. So while, I am an engineer myself, but I kind of get overwhelmed when I see the length and breadth of the technical, innovation that's happening out there. So the way we operate is we have a tag team with the business folks. We prefer if the business sponsors investment opportunity where they come with stronger conviction on the technology itself. Typically, we like investments which are TRL 6, 7, and where we see visibility of taking them to TRL 8, 9.
TRL, just for folks.
TRL is technology readiness level. So that's something that we track very closely. So very, very early TRL or technology being developed is not something that is comforting to us, because the way L&T looks at it is in 2 years, can it reach 1,000 crore outcome, right? So, and that requires very, very quick scale up. And so that's where we want to partner with technology companies in these areas specifically. The investment, there is no specific size of investment, but at least for an innovation fund, the idea is to invest anywhere between $1 to $5 million, take less than 20% stake. And if we get a board seat, that's great. The board seat is normally led by the business folks, because they know strategically how to add value. We prefer going in with a financial investor as well, because the way we look at it is we drive strategic outcomes and we require the financial investor to drive financial outcomes. We also look at it like a VC. We need exits. So exits are very, very important. So pure strategic, to stay in indefinitely is not the outcome that we are looking at. We require financial outcomes as well. And the whole idea is to keep this self-sustaining. So the more exits we are able to generate, the more investments we can make going forward. So that's the mandate.
Thank you. So even if you can't share exact startup names, can you give us a flavor of some of the recent transactions that you've
Sure.
done?
Yeah, we made some very interesting investments. Again, all technology-focused, engineering-focused businesses. So one such company is probably in the public domain, so I can talk about it. It's in the cybersecurity space, which started much before the hype in cybersecurity. The founder is an Indian. He comes with a MI6 background. So he kind of understands the external threats that are out there. The whole idea this company focuses on is to expose threat surfaces. So all businesses have assets out there, and all these assets have certain threat surfaces where, you know, bad actors, the dark web actors, are constantly accessing. And so this startup kind of showcases that to the senior management to say, listen, these are your open threat surfaces. These are the kind of challenges that you will encounter. Largely defense folks are very, very careful about these things. There have been threats on many airports. Heathrow also had a similar threat. Malaysia, Singapore, we are seeing this across the globe because it is not constrained to a certain geography. So this was a big opportunity that we saw, though it was not directly connected to what we do. We did see this as an extension of a services that we had to offer, say from a LTI Mindtree or LTTS as well. So that's one of the big investments. We're very happy with the outcome. Since we invested, the company has grown almost 3 times. It's been profitable for a while now. It has some marquee investors like Goldman Sachs on the cap table as well, who are driving the financial outcomes. So these are some of the investments. The others are in the AI space, but specific to industries that L&T operate in, which is in hydrocarbons, in oil and gas, in construction, where they they focus on optimization, yield improvement kind of areas. Again, far ahead of the curve. India is now talking Industry 4.0. These companies had been in existence for the last 7-8 years who have been developing this. So these are some of the opportunities that we've invested in.
Thank you so much. Srini, at Brand Capital, given your media heritage, the venture folks as well as the private equity folks know you very well. They collaborate with you. But there are also some myths around, what does Brand Capital bring in terms of media visibility, in terms of cash to the companies. So please take us through some of those, as well. And has that changed over time? Right. So.
Absolutely. Thanks for giving that opportunity to share about Brand Capital. Much before doing that, I was just talking to Craig before the session started, given the fact that we do share something in common. I did spend some time at Actis before, which became BII in a way today. And I was saying when I started that we used to make investments in the range of $1 million. It's good to see the old timers like Srini and Gana there, where $1 million investments used to be the headlines in the Economic Times next day. I don't really know whether it get even mentioned today, somewhere in the footnote on the 4th page. I think so, right? Things have really evolved. It also, I think, hearing from L&T Innovation Fund brings back the memories when I spent time as the head of Intel Capital, which I call to be the OG of corporate investments in the world. Given the fact that as somebody who had the responsibility to build Intel Capital program for the whole of South Asia and seen some of those developments, it brings that nostalgic moment in terms of what does it mean by corporate investments, which I'm still doing as a strategic investor here, but in terms of business unit sponsorship, technology alignment, double dipping in terms of making money along with investments, and the technology orientation. I think it sort of brings back those memories, brings back that solidness in terms of making the investments work, right? But coming to what you asked, Arun, Brand Capital, as I said, it's a strategic investment arm of BCCL, which many of us know as Times of India. As I said, it's a 186-year-old organization. One of the oldest media houses, if not in the world, surely in South Asia, which means that it brings lots of credibility, lots of trust to the table. And that's what exactly the largest value add what we bring in terms of our investment. And that's what really played out in terms of the journey, what we have worked with 1,200 plus entrepreneurs, as I said. I think these are evolving entrepreneurs. Many of them, including what we have done in the recent past, 70 to 80%, we are the first institutional investors in these companies. We are the first institutional investors beyond friends, family, obviously some fools who have invested with them, but we are the first institutional investors. which clearly brings in terms of what we have a role in terms of playing that, taking them to the journey to an extent, as I said, 15 of them what have turned to be unicorn in India. I think it's the largest thing. We call ourselves to be an AI company in a different way. We're not artificial intelligence company, but we are an affluent and influential program of the country, what we bring to the table in terms of getting those leaders and influential makers to be part of this journey, right? And what do we bring? What's a program? What's a program of brand capital itself? Yes, it has evolved over the last 20 years. What we essentially say that is we are extremely credible media options what we have across the spectrum, some of the names what I mentioned, and how this media can be utilized as an extremely credible currency for these young and growing entrepreneurs in terms of journey of creating a value. I think if I look back and look at this, but for the data centers which are putting lots of capex in this, and as VCs and PEs who have invested, we go back and see most of the money is going into some 4 or 5 OPEX needs. Depending upon the sector, anywhere between 10 to 30% of that OPEX needs is building the market and the brand of the company, right? And we are essentially bringing that gap up between 10 to 30% of the OPEX needs through this media currency program. That's exactly what brand capital builds in. So we work with entrepreneurs in terms of saying that there is a strategic program rather than a tactical program of looking at brand building. Please look at brand as a value differentiator. Today, if you look at anywhere, why are we building whatever we are building? I mean, quite a few of us, we have iPhones in our hands. Why are we willing to pay 1.2 lakhs to an iPhone where you can buy maybe mostly similar product in Android of other product at about 10 to 20,000 rupees? It's a brand, what speaks to you, the authority, the trust, and the credibility, what brings to that. So what we are saying is the media currency can be used in terms of building that strategic value-added program in a very defined way over the next 4 to 6 years. So very similar to any particular VC/PE fund, what we bring in that brand capital and that media equity, what the company and the entrepreneurs can use in terms of communicating about their brand, about corporate identity in a very structured manner. It's a very high cash leverage program in the sense that for $1 what they have, they can invest $3 in a strategic invest program. So it brings in the 3x leverage for them in terms of talking about their brand and talking about that corporate identity. I think maybe I will also add to this saying that quite a few people think that, oh, I need not talk about my brand because I'm not growing. I'm not a company which need to be talking about my brand because I may be a B2B company, I may be a deep tech company, I may be a space tech company, whatnot. But please appreciate the brand is getting communicated just not for your revenues. It's also getting communicated in terms of defining the corporate identity. Many of the people work with us in terms of defining their thought leadership. I think that's why they're saying that cybersecurity. Today we have couple of cybersecurity companies who are in our portfolio. People come and ask me saying that, how come cybersecurity companies are part of your portfolio, right? Because they need to talk about evolving nature of cybersecurity which is happening in India. I mean, you mentioned about what happened in some of the airports, but nobody's talking about what happened to Jaguar and Tata, right? They lost 2 billion pounds of market capitalization just because of one cyber attack. And if I'm a cybersecurity solutions company, what do I talk about that? How do I bring to the table? What thought should leadership do? So through brand capital program, we bring this media capital. And as I think I said in my opening remark, we are a sector agnostic, size agnostic, and a stage agnostic program. Because as a balance sheet investment, as a single LP, we have the flexibility to be a patient investor. And we go in as early when we are providing just maybe $1 million plus. And the largest what we have done is $35 million in terms of one single investment across the sectors. Maybe I'll just mention a couple of things before any more questions. I think one other thing what I said is category definition, right? Much before even e-commerce became a matter of the day where we can't even without talking about Q-commerce, e-commerce, or a 10-minute delivery, we sort of saw that and the need in terms of the brands to communicate about the thing. Who wanted to get something in 10 minutes, 15 minutes. Today, we can't even live without that, right? And we had to talk to them. And we have to tell people why they should be using those things. And that's where these large companies saw the need for them to work with us to talk about evolving opportunity for them to communicate about that.
Thank you so much. Shantanu, in terms of TBS and its interface with the private equity venture ecosystem here, what have you seen? You also have the benefit of having worked for a long time in Singapore, right? So, give us some flavor of how you are seeing this landscape change and how the relationship with investors is changing.
Sure, thanks. Maybe I'll start a little bit from how this has evolved in Singapore. So we actually have a very large financial sponsor coverage and relationship team in the financial sponsor area where we look at private equities. Now, some of the largest private equities, our relationships are so deep that we not only fund most of their leverage buyouts, and that started long time. So when I have been involved in the leverage buyouts of 5 private equities in IT services space and BPO space in India since 2012-13 at that point of time. And then we graduated as these private equities became bigger. We graduated to providing them subscription line financing, which is basically capital call lines on the back of their LPs commitments. So we do their custody business, we do subscription line, and then do at the asset level, we do leverage buyouts. Then this relationship, then we when we talk about the VC engagement, so this PE is a fairly large, we would have about $30-40 billion of asset exposure from the bank side on the entire PE related ecosystem. Came around 2020, when COVID happened, we realized that we used to see a peculiar phenomena in Southeast Asia, that there is enough risk appetite at the early stage and at a very late stage, where pre-IPO, there was a perceptible dearth of capital when it came to, let's say, Series B plus to Series C to Series D, that kind of stage, where you are sort of looking at scaled up businesses. People are still not willing to take the bigger ticket sizes to that was the overall sort of reflection of the risk appetite of the society out there. So we saw that as a bank, we have an opportunity to step in and support. We created something called this fund in partnership with Temasek, which is basically DBS and Temasek put together about $500 million to come in as venture debt, but not 5 to 10 million, but more in the order of 30 to 50 million ticket size, which is typically much larger than the usual venture debt that you see. And we consciously decided that we will, in the bank's balance sheet, we will work with companies which are closer to their sort of EBITDA break-even or have a visibility that in the next 18 to 24 months there is an EBITDA break-even. They are still burning. And how do we engage with the VCs to identify within their portfolios some of these companies which they feel promise about, and then structure working capital solutions for them which will bring in a certain amount of discipline, because by 2022, at that point, there was a meaningful amount of euphoria. 21 was the most euphoric year when huge amount of capital went in. But we had already seen 1 or 2 disasters in early days where due to this euphoria, there was some accounting mismanagement and things like that, and revenue reportings were erroneous, which led to a downfall of a garment such of textile related startup in Singapore, which was actually very public news at that point of time. So we had a thought that if we as a bank came in with appropriate structured working capital solution, It will not only help the companies delay their next round or fill in that void where they were struggling to raise the Series B plus, Series C, Series D. It is also likely to bring a certain amount of discipline in how things were being run, because that would be the first time the founders, etc., would be asked to monitor some covenants. And this was very welcome with a lot of the VCs who are our partners, whether that is, Sequoia, whether it's Jungle Venture, Monks Hill, and all of that. So that is the relationship that we bring in with the VCs and the venture debt funds, and we have been working in India also with the likes of Axels and all of other VC funds to look through their portfolio companies, see which companies are of at a certain scale where they think that, okay, these are the companies where the business has been proven, it's post-revenue, it's closer to EBITDA break-even, but at this point, we don't think we would be raising equity. It's better to come in with either a venture debt solution or a corporate working capital debt, and that has been our approach, So, for example, if I were to just cite one structure, there was this OTA, which used to park a lot of capital in escrow with different airlines and hotel partners. And that was primarily because these were companies who would not want to take individual settlement risk from the OTA's platform to them. So they used to deduct money from the escrow and provide the ticket, whether it's a hotel booking, whether it's an airline booking. And that amount was primarily funded by equity. We came in and we structured a solution where, say, we will put in $50 million of working capital facility. You draw down from ours for a period of 1 month, whatever is your best estimate, and then you park that, and then whatever is collected, because if your business is proven, then the contribution margin has to be positive. It cannot be negative at the contribution margin level. Of course, at EBITDA level, you are still negative. But if you collect, you use that proceeds to zero down the facility within 1 month. Now, if your estimate was 10 million, you zeroed it down within 21 days, next time you draw 15 million. If your estimate was 10, but you took 45 days to zero it down, next time you draw down 8 million. So we had a control on the facility, but it led to release of $50 million of equity for that business. And it was also a de-risked facility for the bank. So there are some examples, quite a few such examples, but this is how we approached and work with the VCs and the companies to sort of enable their growth, at the same time see how we can bring in a certain amount of discipline. So that has been our approach, in terms of how we partner with this company.
Oh, very interesting. And incidentally, since you talked about buyouts and financing them in Singapore context, recently RBI has kind of explicitly come out saying Indian banks can finance acquisitions at this point, right? So, can you throw some light on that? And
sure.
Yeah.
So that is both an opportunity and a bit of a threat for a foreign banks like us, because so far the acquisition finance market was closed for most of the Indian banks. So the route that people would use would be external commercial borrowings, whether that is through FPI, because we have ourselves a foreign portfolio investment license. So you use FPI route to fund those, because whenever somebody is buying shares, it was not allowed. So the fact that RBI is looking at it reflects on the overall, if you see, there is an overall, positive direction in which a lot of the reforms that RBI is now talking about are moving. This being one of them, there are certain reforms around project finance which will also impact this. So what is likely to happen because of this is that most Indian banks would now be allowed, and we think so far it's a draft. They have used local corporates. So they would be allowed to participate in acquisition financing by local corporates. So this will definitely create a much more robust and positive environment for the Indian banking system to participate and facilitate acquisitions, which will therefore lead to a lot of liquidity available from a behemoths like SBI and HDFC, which were outside the system. But at the same time, there are certain relaxations that RBI have come up with in the external commercial borrowing ECB regulations, where there used to have a certain amount of, tenor floor, that minimum 5 years, minimum 7 years. Certain sectors were open, certain sectors were not open. RBI is relaxing that. So that will also create an opportunity for the same, on one hand, acquisition finance used to be a domain of foreign banks that is now opened up to Indian banks. But on the other hand, where in infrastructure and project finance, where you can use ECB, there was certain amount of restrictions which Indian banks had a bit of advantage in terms of tenor. Now those are also been relaxed. So there is, in general, we feel that there's going to be a lot of positive competition which will enable these deals much more frequently, and may have an impact on valuations, because as more leverage is available, you may see valuations go up for whatever.
Thank you so much. Mukesh, this is a season of IPOs, right? So, and just from, see, we have a daily newsletter that goes out, and we just can't cope with the flow in terms of the number of IPOs that are lined up. We have from the RHP filings to SEBI clearing them to, the actual motion of the IPO. But, so my instruction to the team is no longer talking about IPOs that are going through the pipeline, the ones that don't make it. That's news for us, right? So, and we have seen various IPOs for various reasons, which have been delayed at, various stages of this pipeline, right? So, and obviously a lot of that is governance related, what SEBI looks at favorably, not so favorably. And, what have you seen from a diligence perspective, and what is your advice to the venture private equity fund managers on the kind of obvious red flags and, what they should watch out for from a SEBI lens, for example? Please throw some light on that.
Interesting point you brought forward. Our journey with IPO actually starts off almost 18 to 24 months before the IPO actually makes it to a prospectus stage or a prospectus is cleared. The process usually starts on two sides. Basically, the investing company coming to us and say, we are now on the IPO track. We need to actually plan an IPO, appointment of merchant bankers. But before we do that, we need to clean up our inside. Basically look at governance structures, look at policies in terms of how they engage with vendors, how they engage with employees, and other stuff that will basically help them, improve transparency, as also a focus is also on valuation. And then you prepare the company on for the fit and proper check. Typically what happens is SEBI is very conscious of every single name that goes into the IPO document or the red herring prospectus, so they do not have any kind of negativity or any kind of risk that comes in. And the second one is, of course, disclosures. So we prepare the company in terms of what you already know, you disclose, and even what you do not know, let's find out. So quite often today, with activism and with social media coming in, there are posts made by some former employee, there are Glassdoor reviews, there are various other forums where people express. Many a times companies are completely oblivious of such comments being there in the public domain. Our job is to basically dig out, prepare, and help them prepare a defense. Because tomorrow SEBI is going to be using certain tools to basically find out whether you've made all disclosures, and if there are any controversial things that's happened in the past, you need to address that. So if you go to SEBI with the application with all clarification and said, if you do this search, you'll find this, and this is what our clarification is on that, you tend to get a much more weightage than if SEBI finds you with your hand in the cookie jar. So that happens a lot. Preparing the fit and proper is not a simple and easy thing. A lot of rejigging happens, a lot of names go in and out of the system. And quite often, when we receive the mandates for actually a check on companies for IPO, we're talking about almost like what 30 to 50 names that come to us. So it is the people are getting conscious, and most of the time this is driven more by merchant bankers. But we've had at situations where even before they go to the merchant banker, they're coming to us. So that things are changing a bit on that side. A lot of companies do have had conducted this exercise, and we haven't seen them in the IPO space as yet. I'm not at liberty to share the names, but yes, when you asked about how many did not make it, there are quite a few of them who do not make it.
So back to the investors in terms of just the IPO readiness of some of your portfolio companies. What do you think are at this point the crucial elements in preparing companies, because today we have the SME IPO also as an option. So how are you looking at some of the portfolio companies either in the current fund, which may be a bit away for you, but even some of the older investments? In terms of just preparing them, looking at just the options, should I go SME? Should I take the main board only? Because I've had entrepreneurs who kind of consider SME IPOs not so a great option. They will take it unwillingly, but things are changing. So how are you advising companies that want to take advantage of the current wide open IPO window? And what is the best practice in terms of getting them to the big day? Go first, yeah.
Yeah. Interesting times, right? When we are talking about, I think the number is somewhere close to 2 lakh crores, which will be raised through IPOs this year, this calendar year, which is going to be second largest in the history of Indian financial markets, I think. Maybe even more than that. And people are saying that there are about 3 to 4 million retail investors who are waiting on the fringes to join this frenzy next year. So we may even see much higher than this. I think one of the numbers what I also saw is anywhere between 10 to 20 billion dollars is on the fringes in terms of hitting the ECM markets in the next 2 years. I think before even we talk about that, two things come to my mind as somebody who has seen and who has served on the boards of the companies which have gone to the IPO over the last 25, 30 years of my experience of investing, right? I think I echo to the point to say that it is just not a switch, which suddenly on one particular day I say that as an entrepreneur, today I become a listed company. It's a journey. As an aspiring marathoner, I can say that it's a marathon rather than a sprint. It doesn't happen in terms of you running for a 900 or a kilometer. You are running for that 43 kilometers as a marathoner. So you need to prepare yourself. I think I can also, given the fact that there are some old-timers like me, can somebody tell me what was, I think, with the first movie of Amir Khan? QSQT, right? In the context, I mean, which was Kayamat Se Kayamat Tak, I think lots of Gen Z guys will still starts. What is this Kayamat Se Kayamat Tak? It was a cult film. It was a launch film of Amir Khan, right? In the context of IPO and a company, I think I keep telling my entrepreneurs whenever they're talking about, you will be running through the journey of QSQT. Only the journey of QSQT is rightly changing to say that it is quarter se quarter tak, right? You are living from one quarter to the other quarter in terms of meeting the eyes of your investors, your analysts. So I think what private markets really value a vision. I want to become a big. I want to be the largest AI company in the country. I want to be the largest Q-commerce company in the country. And the PE VC guys like me really think that we will give you millions of dollars. I think that will be the private company which value vision. The public markets really value the certainty and predictability. So if I'm saying some sort of a direction, will I be able to meet my direction? Will I be meet the numbers what I've told to the people? I think that's the largest journey what the people are realizing today going through this. I think the entrepreneurs and the people who are working with the founders have to think through that process. Am I making that? Am I willing to make those adjustments in terms of my corporate governance? And the board meetings which are not going to happen at my house around the dinner table, but actually in independent directors who are going to be asking me questions, who are going to be validating my assumptions. Am I prepared? Am I willing to do that? Actually, I met one of the other very interesting guy recently who said that apart from lots of things what you need to do, as a founder, he has to actually take care of the health of himself and his founding team and the critical CXOs as he preparing the journey of becoming public and listed company. Saying that how will I be able to print myself or make myself visible as a stress-free somebody who can take this and health being there as a conscious? Will I have a health meter for myself and my CXOs to go through the journey of this IPO? So I think they are very, very interesting things, by the way these things happen. And we at Brand Capital have the experience in terms of seeing 2 IPOs happen in the last year, and one of them on the verge of happening today, and one which is going through the flip. I think we didn't talk about the Garvopsy scheme, which seems to be happening in quite a lot in terms of many of these companies, which are flipping and coming to, for whatever the reasons, including the valuation multiples, to coming and getting listed in India. But my guess is these are interesting times, many, many things for us to learn and adopt.
Thank you, Craig. Your perspective on IPOs and IPO readiness?
I probably don't have anything to add directly on that, so.
I only have my past experience to speak of, and I completely concur with what Srini says. It is a marathon, and unless the founder and the founding team are absolutely ready for something like that, it is not something that one would recommend otherwise. Yes, there is liquidity in the market, and hence you should tap into it, but it takes a lot of effort to be IPO ready. Corporate governance is definitely top on that list. SEBI is only getting more and more strict with every passing day. The way you maintain your books, the way you take your decisions, the various committees that you have, the way you engage with your independent directors, and this quarter-on-quarter business, right? I mean, it is a drain, right? Half the time is only going and reviewing what happened in the previous quarter, and the other half is preparing for the next quarter. So where is actually the whole, when you're talking of innovation, and if you are a tech startup, that your right to win was the way you were agile, the way you were taking decisions, that probably will get curtailed in some way if you go public. So hence, it's very important to really sit back and review the need to go public. Of course, the PEVCs will want a liquidity through an IPO, but if there are other options, and if you can push it to as far as you can, that would be the recommendation.
Thank you so much. So we have 15-20 minutes left on this panel that we wanted to reserve for questions from the audience. So if you have questions already, let's get a mic across, and we can always go back to the panel, but I would rather have it interactive. So if you have a specific question to any of these individuals, please put it to them. If it's for the entire panel to take, we can go for it. We can come back to the panel, but I thought we should engage with the audience as well. Can we get him a mic? Mr. Arvind has a question. Yeah, so let me just start off, and then please get him a mic. Yeah, thank you.
Arun, that was a fantastic panel discussion. I have some questions. One is for Sushma. You mentioned the L&T Innovation Fund. It's really fantastic what you're doing. And I will just read the 3 questions before you can answer them. The government of India has announced a $12 billion deep tech fund to be allocated in different forms, and the India Deep Tech Association has been formed. What is your view on that? For Santanu, that was fantastic what you said, was very informative. The subscription lines that you mentioned, how popular are they with funds in India, with the AIFs market, and whether the SEBI allows it, not allow it, how is that structured? And Srini, thank you very much for your discussion. You mentioned the brand, the brand subscription, which is more non-cash. I think that's the impression I got. What is when you invest in a company, do you invest only in non-cash, or do you invest in cash? Just for your consideration.
Great. No, thanks so much for bringing that up. The whole RDI scheme through NRF, made the splash I think early this week, and the IDTA, the India Deep Tech Alliance, that has started taking shape and momentum, started with a bunch of VCP folks, but now they are seeing a lot of corporate interest as well. The governing bodies, the policy makers, the government, they are all being part of this body. And hence, I think it's coming of age for technology companies, especially coming out of India. I think the whole PEVC ecosystem has been seeing certain cycles. The first was probably BFSI. That's where you started seeing a lot of interest initially, and hence that's when a lot of success stories came out of. The second phase was in the consumer ecosystem, which is still seeing a lot of uptick and a lot of corporate interest in the FMCG area as well. And now I think is the time for engineering companies to also start taking a precedence. And that's when deep tech in India is so much required. We need more participants to participate in building indigenous technology. I think India has been relying far too long on technology that has been coming from outside, which puts us at a slightly more vulnerable position. We do have the talent, we do have the capabilities, which I can say very, very confidently after seeing, the kind of work we do at L&T itself. And hence, there's no reason for us not to develop things in our country. We do require capital support, we do require government intervention, we require policy interventions as well, and hence this Deep Tech Alliance is a welcome requirement in this ecosystem. And as a corporate, we too are looking to be an important member in this ecosystem.
So, yeah, subscription line financing is quite attractive to PEs because obvious reason that increases their IRR. And when it comes to AIF, SEBI still doesn't allow the AIF structure. So the three subscription line financings that we have done are for the standard GPs. These are the fund outside India. We have done through either Singapore or through Gift City. But we remain hopeful. Maybe at some point SEBI may open up to this, but as of now, for AIFs, it's not allowed. So that's a quick answer to it.
GPs are Indian GPs or?
Yeah, Indian GPs. I mean, the overall, they're very familiar names. I'm not going to take the names here, but very familiar. Their names have been mentioned in this panel a couple of times already.
Yeah. Sorry, there was a question about brand capital model. Much before I answer that, as a group, Times of India, we have multiple ways in terms of investing. I'll come to the brand capital model as somebody, I'm heading that up. So Times of India does cash investments, but in a very specific areas, what we call as new initiatives. That is very much limited to 3-4 areas right now. One is sports. Second is in learning and skilling. Third is healthcare, specifically in longevity and curated experiences. We just started both programs. Some of them are very, very confidential. Some we have done, some acqui-hire, some cash investments. So that's one program. And then through the Times of India investments, there is also a company called Times Internet Limited, which is part of the family. Through that too, we do both acquisitions as well as cash investments, both anywhere starting from minority up to majority. Those are in new media, media tech. Those are that investments, what we do, those programs. But coming to brand capital specifically, you're absolutely right. It's a media for equity model. But having said that, I think there are two big differences, what I would like to say. One, as I said today, depending upon the sector, anywhere between 15 to 30% of the OPEX needs are still talking about marketing and communication. And that's a big need. And very similar to venture debt being a complementary role to PE/VC fund, we do believe that we are a very, very large complementary role to the VCP funds, what's happening today. And that's a large role, what we are playing for the last 20 years. And I did say that we have committed something close to $4 billion plus in these last 20 years. I think beyond that, one specific differentiation is what I call to be walk the talk, which that we, as one of the largest and the oldest media houses, we know that we can make the difference in terms of the brand and the way the brand needs to be communicated. So we are actually working as fractional CMOs of all our investment companies. We have a dedicated team of 7 people in my team within Brand Capital, which is called Brand Strategy. And this team works with all our portfolio companies as an extended arm of the marketing and the branding team. And we think that that's the largest value addition and the value creation what we are doing in our companies.
Hi. A question is slightly from a different perspective. Because I heard that we want to be the largest player in whatever sectors we are in. That's the focus area. The challenge is when everyone is chasing, I think the foundation is you have all across levels. If you have players, then the foundation is strong for any sector. Certainly, we all have seen in the recent past, when everyone is chasing always to be the top, rather the foundation is weak and many are falling actually. And we have seen that. And as investors, especially even the brand capital, you would have seen quite a number of people falling down. In terms of your internal discussions, is it a challenging thing for the ecosystem itself? I'm not concerned about one particular investment making money and others losing as an ecosystem, because when everyone is chasing all the way to the top, there are enough boundaries, and eventually if they land up being in an IPO, then there's a factor that common investors are also going to lose out. I think this is something I would like you to throw up. What are your insights around this, and what kind of risk mitigative steps you are taking it with the past experience of such happenings?
You want me to reflect on this? And all of us. Okay. Maybe I'll go first, and then maybe other people will have views to share this, right? I think it's like horses for the courses, as I call it. And that's the very reason why you have multiple investment programs. And I think Arun has put together beautifully the program in terms of venture capital, which is early stage, higher risk, and hopefully higher return program. There is a growth capital program. There is a private equity program. And then there is maybe a pre-IPO program and post-PIPE investments too. So your risk profile as you take through that, and amount of risk what you're taking there going to be much, much higher. I mean, it's been well there. I mean, not just in India, worldwide, if you see, specifically in the startup ecosystem investments, if you see. And over the years, empirical data gives you this, that approximately 20% of the investment will give you back that 1x plus sort of at the fund stage. So when you're investing, obviously you're taking that portfolio approach. Any fund will make anywhere between 12 to 15 investments, give or take. So you're saying that there are 2 or 3 of them, maybe if I'm really good, 3, 4 of them will give me that 3x, 4x, 5x returns. A bunch of them where I may get just about lesser or somewhere around less than 1x return. And there will be 3, 4 of them where I will be losing my shirt and everything else, right? But when I'm going there, I will not know how it is going to be paying out. So you're absolutely right. How do I make sure that I'm building a portfolio approach and the risk mitigation in terms of my own due diligences? And my own work about that. So that's the reason why even AF guidelines have put, and we ourselves are putting our own guidelines in terms of whether it's a sector exposure, a size exposure, or how much do I want to put, when do I want to do, how do I keep going across doing this, I think. Will there be, after doing all this, will there be still failures? I'll be lying through my teeth if I say there are not going to be any failures. There will absolutely be failures. The question is that, am I aware of them? Or can I learn from these failures and will not recommit and redo that mistakes in my next investments? I think broadly that's how I look at in my 25 years of experience.
Does anybody have anything to add on that question? So are there any more questions lined up? We can, yeah, there's one there. We'll take that and then go back to the panel. Yeah. Hari, over here. In the front, yeah. Just wait for the mic to reach you, please. If you can put your hand up for the mic to reach you, yeah. There's one in the front. Yeah, go for it.
Hello. Good morning, everyone. My name is Kunal. My question would be to the entire panel, the funds that are there on the panel, especially Sushma, because she mentioned that the fund has invested in a few startups recently. So my question would be, what kind of challenges do you usually face before you all zero down on any sort of an investment? And in terms of transparency and ethics, what kind of challenge do you usually face and how do you tackle them?
Okay, that's a tricky question to answer, right? Because when you first start evaluating a proposal, you want to see the merits of the proposal. We don't go looking or poking holes on what is the quality of the governance, what is the promoter's real intent and things like that. Yes, those are challenges, but first we try to overcome the hurdles of, what is the business actually doing and is this a good business opportunity or not. But when it does come to, when we say, yes, we like what we see and what we hear and we want to take it forward, that's when we do our diligence, right? So that's when we have people like CIGAER to help us with forensics and background checks to then validate whether what they are saying is actually true and whether, because see, in this business, it's all about trust. If we have invested, we invest in them for about 5 to 6 years. And we cannot have an incident where just because we did not do our diligence, something failed. So we do deep diligence on backgrounds of people that we are investing in, and only when we are adequately satisfied do we go ahead with these investments. But it's not the first thing we do when we are interacting with people.
Thank you. We can take further questions to the, we have, like I said, a venture panel to follow and so on. So we're just on the cusp of finishing this one, and we will take any other questions to this panel, offline. So we'll go with the lady. We'll just give her the final question for this panel.
Thank you. Good morning. My question is to Mr. Mukesh. Of the experience that you have, and you said there are many IPOs which are of late not seeing the light of the day. Other than corporate governance, do you see any common trends that is happening that, because of which the IPO has been not seeing the light of the day?
See, the actual answer to that only SEBI can actually provide. But what happens is many a times disclosure issues delays things. Many a times first observation, second observation delays things. Then the companies then really go back to the drawing board and say, it is really worth going this way, we can do the other way, or we just don't want to do it immediately, we can actually delay it. Majority of the issues that we come up during our diligence process or our fit and proper process is stuff that the promoters are not aware of themselves. A lot of things that actually are spoken about on glass doors and other various forums about maybe a whistleblower complaint or something relating to harassment issues within the organization. These things are many a times at corporate levels are shoved aside or kind of ignored, or somebody just kind of eased out, and these guys, they want to voice their view on what exactly happened. These things never make up to the company. So majority of the cases is more to do with that. It's not exactly business, it's more to do with other environmental issues. Apart from that, you will have a situation where if there are too many red flags coming up on the company and they know that the SEBI will crack down heavily upon you, they would rather want to actually wait for some more longer period and reject the people who are in that position just to ensure that they do not feature in the red herring prospectus. So these kind of delays do happen, and I wouldn't say all these cases that we have done would actually not see the light of the day, but it will eventually happen. But delays is eventual.
Thank you.
Thank you so much. I would like to end this panel with going around the panel in terms of what is the one thing that excites you at this point in time most about the private equity venture ecosystem in the country. And I would note that we've not used the word AI throughout this panel, right? So that's fabulous. And we'll have enough AI coming at us in the next one, which is the venture capital panel. But yeah, we'll go around starting with you, Mukesh, in terms of one thing that excites you the most and one thing AI terrifies me the most. So one thing that probably is challenging or, looking at it with concern for you.
So I'm going to be a little biased in terms of the business background that I come from. What really excites me more is more and more adoptions in the PE space and VC space, where people are wanting to actually engage with external vendors to actually understand their investing companies better. Also, there's a information overload, a lot of information, or a lot of queries that come to us in terms of how do we filter through this information. One example, if you don't mind, I will indulge further, is that we've had a client of ours who's actually invested in a company for almost 3 years, and the promoter has gone kind of quiet. And they were worried whether the promoter has got into some terminal illness or some other problem, and they are concerned. They've, instead of asking questions directly, they actually engage with us to say, can you find out what's happening? So these kind of engagements are increasing, and that's the most exciting thing for the next decade.
Maybe because I come from a banking lens, what excites me most as of now in the PEVC ecosystem is the focus on profitability and back to the basics. Because there was a time when there was so much of an irrational exuberance that if a term sheet came from SoftBank, within 15 days you will get a term sheet from Tiger. And again, just anecdotal experience, like when we used to go and meet some of the clients in 2022 in India, they were like totally averse to discussing debt because they would look at our term sheet and say, what are all these covenants, this, that, and equity term sheet doesn't talk about that. And lo and behold, the same guys then today, they say, you know what, these guys asked me to focus on revenue. I didn't look that 7 lines below, there was a line called EBITDA. Now these guys are asking me to look at EBITDA. That's music to our ears because that's when a banker can come in and play. So I'm very excited that finally there is a lot of, sagacity coming back to the market. That's my
Any
excitement.
concerns? It's the same thing effectively.
Yeah.
Okay, Srini.
Yeah. I think for me it is the resilience and the confidence of the larger Indian ecosystem, right? I think we've seen many headwinds, we've seen many tailwinds, but as a complete country, as a 1.4 billion people, the fact that we are multi-sector focused, multi-stage focused, and we keep coming back in terms of the self-reliance and the confidence in the system to say that we can prove it for ourselves, and today we can even prove to the world. I think that gives me the confidence saying that the last decade of disruption is going to continue to be the decade of desire and deliverability for the next 2 decades to come.
Thank you. Craig?
I think from my perspective, from an LP perspective, is actually that GPs are now focusing on exits, actually taking money off the table, not just through IPOs, but secondary opportunities that are coming up, strategic sales, and even taking part of the money off the table and leaving some of it on the table for potentially the IPO. So that 5-10 years ago was not happening. I'm actually happy to see GPs actually doing that now, giving money back to the LPs, which is good for the industry.
Thank you. Sushma.
Coming from an organization who strongly believes to be the nation builder for India, right? Seeing a lot of young founders coming out of our great educational institutions like the IITs, coming up with very, very unique, innovative technology products is something that really excites me. And I really hope we see some, bigger than NVIDIA companies coming out of India soon.
Well, thank you so much, panel. I think it's been very interactive and we are bang on time. So, over to you.
No, thank you, panel. I think what we began with was a lot of talk on uncertainty, conflict, and turmoil, but we've actually ended up with a very, very positive note, exciting note as well, on the investment opportunity, the growth, and the positive outlook in the market today, along with the resilience. So thank you. We live in very interesting times indeed. Thank you, panel, for being very, very enriching and very positive. I will now invite Mr. Natarajan, Managing Partner, Zenith HR, to facilitate the panel. And can you please also stand up for a group photograph? All right, audience, I think you've been also a very interactive audience. I love the questions that came about. So we will now, have a short break for networking. And as Arun mentioned, our next panel is a panel